Thank you, gentlemen, for joining today on this panel discussion. I think suffice to say, we're probably all a little tired about hearing about COVID and pandemic-related issues, but we're going to try to explore a bit more of those things today in this panel session. And we'll roughly break it into two segments. The first part, we'll kind of talk about, the effects that this pandemic may have had on commodities and the market generally, and look to get each of your views in that respect. Then the second part, we might deal about something that's been a little bit more timely, and it's been the craziness that's gone on more recently with Reddit and various things around that, as perhaps another kind of pandemic-induced event. So we'll start off. Clearly one of the elements that we're interested about, and we'll listen to Byron lead us off, is the kinds of things that you've seen, Byron, here that the pandemic has done to either the commodity or the market that you see relevant from your perspective as a sophisticated student of the market and also a private investor.
Well, thank you for letting me be here. Thank you for the nice introductions. The last year obviously has been tumultuous. I mean, it kind of reminds me of what Vladimir Lenin said, that there are years when nothing happens, and then there are times when decades occur. We've definitely lived in a time when decades occur, which is the last year. We've compressed so much time into the last 9 or 10 months, and that's going to continue in terms of just people's behavior. I mean, massive, literally continental scale lockdowns, the inability to move, but the ability to open up through technology. I mean, we've taken individual decision making and individual thinking, and by hooking people up online in the ways that have happened, I think we've accelerated the process of crowdsourcing of ideas and crowdsourcing of trends, which we've seen that recently with the GameStop and all that sort of thing. But it's happening in many other ways. Another angle on it is that the Western world in general, certainly the United States, where I am, sort of awakened suddenly to the fact that, gee, we spent 30 years offshoring and outsourcing all this stuff. We don't make our own pharmaceuticals. We don't make most of our own medical products. We don't make so many things. And that hit home in a personal sense to everybody when they couldn't even buy, a bottle of aspirin or ibuprofen. It's all made in China, and it was all on some dock somewhere, because the container didn't come in. But that's also extended into the commodity space, because a lot of very savvy people, such as, we have in our audience and our presenters at this conference, they're bringing home and they're understanding the point that so much of the foundational material of our life, the things that go into, a cell phone, there's 63 elements of the periodic table inside my iPhone here, where do they come from? Who makes them? When you get into the exotic stuff, I don't just mean the silicon or the iron or the aluminum. When you get into the rare earths and you get into the technology metals, that stuff all comes from somewhere else. I mean, we don't make those things. We don't mine it, mill it, manufacture it in the U.S. And so people are waking up to this. And so this is part of the whole commodity breakout, mines and metals. And then obviously, I think we are really about to see a gigantic explosion, no pun intended, in the energy sector as well, because things have just been so screwed up for the last year. The pressure, the compression in the energy space is finally just breaking loose. The freeze in Texas that shut down 40% of U.S. oil production. I mean, it's just a license for the rest of the world, to raise prices for oil, and you see natural gas spikes. So we are in an exciting time. There's a way to play this investment wise, and if you're in it, you're already starting to see it. And I don't just mean gold and silver. I mean a lot of different things, copper and others. Right. I'll let you go.
Yeah, well, so there's no doubt about it. The restriction of the driving season and the curtailment of airlines and through the pandemic definitely has hit the energy, oil and gas sector head on. But from your perspective, Trey, have you seen anything in the mining metals world that the pandemic has affected or may change our thinking about for the future with respect to the kinds of metals that may be important for the future, given what's gone on?
Well, yeah, I think that Byron really touched on it. Things like the rare earths are coming to the forefront. That has, part of the pandemic thing is, it came from China. We're blaming China. Of course, then we're also selling jets to Taiwan, and the Chinese aren't real happy about that, and so they're again talking about restricting the rare earths. So they produce about 80%. So that's something. You've also seen, I think, through the pandemic and that phenomena that Byron spoke on of things speeding up. So now the electric vehicle and that whole electric battery phase and green energy, the Bidens and the whole Democratic parties in the United States anyway, their green initiative is starting to put a focus on all of these different battery metals, and you can't really blame the pandemic for that so much, but you can certainly, as I said, that speeding up of things is. It all seems so imminent right now, and even though the real electric vehicle phase growing is still tiny, and it's going to be many years before it really takes over. Everybody's thinking faster these days, I think. But I think the main thing that, what you're looking at is a saying we have here in the United States, but never let a good pandemic go to waste. That certainly has been, it's on both sides of the political aisle. Let's throw trillions of dollars at this thing. And some of it certainly, needed as people got suddenly laid off and we had all this draconian shutdowns and everything. And, which we're seeing, especially in the United States and throughout Europe, that these shutdowns really didn't work. The states here that haven't really shut down much or not having as much problem really, as the ones that have, and so in throwing that money out, I'm going to flip a slide up here just to give everybody an idea of what we've really seen here as far as money, and of course I was talking when we first got on about some of us that are older, remember the days when back in the 80s and even early 90s when the monthly thing that was watched, the data point was money supply, not employment. And this isn't as long a term chart as I'd like to see, but you can see some of these bigger spikes of money supply, and of course 09 and then even 12 after what was termed the Great Recession. 01 and 02 after the market crash there in the tech bubble. If you go back to the 80s, during the high inflation times, you had money supply up in the 16 to 18%, similar to here in 02. And then you have to go way back to the end of World War II for another spike of in that 15 to 20% range. Well, here we are now, at a lofty 30, 34, 35% increase in money supply. And what this means is that, you're going to have, when you throw money around like this and this kind of liquidity, you're going to have a lot of malinvestment. You're going to have people looking at things that they can buy. So hard assets will tend to go up. It's a very inflationary, and so we're starting to see that with a huge PPI number, and the Fed now changing the way they're looking at inflation. So they're going to be allowing some of these big numbers without really tightening, and it's just a a spring that, it's already affected lumber, it's affected agriculture. I mean, across the board on commodities, they're skyrocketing, and we're starting to see it in prices. And now we're seeing that Cargill and Kraft Heinz announced yesterday they're going to start pushing those prices on to the consumer, those increasing food prices. So, of course, that gets down into the metal. The longer term story for copper really is very bullish with this electric vehicles. I mean, how are we going to get the power to everybody's garage to charge these cars? And these charging stations put up, and a lot of infrastructure there. In some cases, as we're figuring out down here in Texas, maybe a reworking of the entire electric grid. But so a big effect on metal prices across the board. You've seen silver outperforming gold, which is typical in a real when you see the commodities running on a strong economy. But the strength in the economy here is, I think, going to prove to be short-lived, in that, when you throw this kind of money around, this stimulus, if you will, it can get things moving pretty quickly. And short-term, it can have a good effect on what really was a good economy anyway, especially in the United States. But when that money runs out, it can fade pretty quickly too, and that's where we think we'll see then gold catch up. But for the meantime, it's a party in the commodity markets.
Jamie, I don't know if we lost you. I don't know. Your picture is gone, but John, we have lost a participant. Okay, well, maybe back to you, Brian, while we're waiting for Jamie to come back at us. Clearly one of the things that Trey has pointed to, and what has been an issue that's unequivocal here, is that there's been so much stimulus put into the market to counteract the potential implications of a slowdown of economic conditions, that we've had really a real influx of cheap money. And so Trey's already touched a little bit on the impact that might have on bullion. But I'd be interested to see your view, as from your perspective, whether there's been other areas where that cheap money has or may potentially express itself, and how that might work out in the future as we kind of back away from that cheap money.
Oh, it's that spike in the M1 that Trey showed. I mean, a lot of people have seen that chart. I hope, if you haven't, that's a chart that really ought to scare you, because there's just the quantity of money, but then we have to talk about the velocity of money too. I mean, if everybody has money but nobody's spending it because they're all locked up in their houses or something, that's one thing. But if people have money and they start to spend it a lot, that's something else. I mean, we mentioned that, say, lumber prices are going up. Well, a lot of people are at home and they're fixing their houses, or they're adding on to their houses with an addition or what have you. Home building, home building is soaking up that lumber, which is why the prices are going up, among other things. I'd also look at a lot of that M1 that's pouring in. I'd break it into a couple different views. Let's just break it into two things, really. There are tens of millions of people, tens of millions of people in the United States and probably elsewhere in the world, who are living, this close to the edge of existence. They're past due on their rent. They got no money to buy food, can't put gas in the car. They lost their job. And they are really in extremis. And these are the people who the politicians and there's an element of the media that's out there saying, oh, we have to get money to these people so they don't starve and everything else. And my answer to that, having studied economics and whatever for many, many years, is, yeah, you're darn right, we do. The last thing we want is, tens of millions of people evicted from their homes, the kind of social dislocation that comes from that. And, and yeah, I understand the part about, we're, inflating the currency and all this kind of stuff. But you know what? Right now, I think it's better to do that than to just sort of use some classical economic theory that we should just sort of let people starve and teach them a lesson or something. No, put the money out there. But a lot of that other money, A lot of that other, M1 that's out there, that's not money going to the single mom who lost her job as a waitress down at the diner. That money isn't going, for the people who are truly in need. That money is going to, that's money that the Fed is using to buy bonds, under the table, and just kind of prop up the bond market, and the plunge protection team that's propping up the stock market. And there's your asset inflation there. There's where your artwork goes up in the $100 million condos in New York and things like that. And there's your big fat inflated bubble on Wall Street. So there, there's many ways to look at it, but I'm just trying to simplify it to you got to help people who need help, but we're helping a lot of people who don't need help. So that's but we're also paving the way. I mentioned this before I forget it. We're paving the way to teaching people that they should expect this concept of a basic income, a uniform basic income, where everybody's going to get a check in the mail from the government, in their bank account every month from the government, and universal basic income. Where does that take us now? And that's a whole nother entitlement. That's Social Security all over again.
Well, talking to a Canadian, I think we have some some sense of where that comes from, but. Trey, I know, excuse me, corporately, you're involved with gold and have some clear sympathies there. Hi, Jamie, you're back.
Yeah, sorry about that.
So
I was kicked off for some reason. I don't know why.
Okay. Well, I was just going to ask Trey here about bullion. Clearly the cheap money supply that has come out, and maybe we can share some of this with Jamie, but the access to cheap money has definitely had some support to bullion. And, I've been all my life in gold mining or capital markets related with gold. But, when I took economics, I don't recall ever seeing someone talking about negative interest rates and what that might do. And that clearly has had an impact, I would say, on the financial commodities like a gold or perhaps a silver. What happens when we go forward here and we start to readjust the balance back to a more normal-ish type capital market, I'm going to say? And, I'll ask that kind of question to you, Trey, but also Jamie, if you could kind of pick up at some point and say, how do you manage through that process? How, as a professional money manager, which you've been most of your life, how do you deal with that? So go ahead, Trey, please.
Well, first of all, Barry, I would say my opinion is we are a long way if we will ever see what you call normal again. I mean, things have been, there's just the debt has in the United States anyway. It's just skyrocketing through this pandemic, and you have the Fed intent on doing things that they were never really set up to do, and like Byron talked about buying bonds and other ways of stimulating the economy, and we're starting to see it now. On the long end of the yield curve. I mean, the Fed can talk about zero rates, and they can keep the bank rates, the interbank rates at zero or negative. But you now have about 125 on the 10-year and over 2% on the 30-year. That's just the market talking there. Now the Fed can and probably will come in and start buying some of those longer term bonds to cap that off, but they're just delaying the inevitable. So as it relates to bullion now, I think two things people are missing and want to keep track of, but not get too. I'm bullish on gold, more probably right now, more bullish on silver, just because it's not only a money metal, but it's also an industrial metal and widely used and probably in shorter supply right now than gold bullion. But interest rates are one thing that compete with gold. So that's the headwind for gold right now is interest rates and positive interest rate spreads. And then secondly, as long as this pandemic has, from the beginning really of the pandemic and all the shutdowns, a lot of countries that have been historically buyers of bullion have been either net sellers or just strictly not buying.
Right.
Countries like Turkey and some of the Eastern countries that can't just print money because nobody really wants their money, right? So they actually have to come up with some real store of value, which is why those countries are realize that and are big gold buyers in the first place. So we've got some headwinds for bullion. I don't think it's going to be off to the races, but as some people thought, and of course when Bank of America shouted $3,000 and Warren Buffett jumped in, those were probably the two strongest signals you could have had that that 2075, whatever the exact peak was, maybe was going to be the top for a while.
Maybe, Trey, if we could just get some views from Jamie. So, Jamie, the years that you've been managing people's money and managing gold funds, how would you kind of put this pandemic-induced low interest rate environment in context for how you would manage through it, what you see for bullion or other commodities, and how you might kind of position money to either be neutral to it or exposed to it?
Yeah, there's a lot of moving parts here, obviously, that we're touching on, right? And it's the old adage, you got to dance while the music's playing. And I agree. I don't know how or when or how long it will take to get back to your so-called normal market, right? Because it is an irrational market, and it is so far from normal. And all of it is, with the valuations where we are in the stock market, there's only two ways out of this. Obviously, another reset, like the dot-com bubble and the collapse and some type of reset there, or we grow into the valuations that currently are implied in the stock market. And what we've all been touching on so far is, the federal government in the US, and actually most governments globally, let's call them in developed democratic markets, let's call it that, have been on the gas pedal since the global financial crisis. And so it's one form of printing money after another to fund deficits to what people have coined as financial repression. So you're seeing the pickup in precious metals or commodities or hard assets or art or collectibles, food price inflation across the market, even though the governments tell us there's no inflation out there. You're seeing this general asset price inflation, even in the stock market. So when I print endless amounts of money and dump that into the stock market, there is a scramble globally to get off of what is perceived as devaluing fiat currencies and buy me stuff, right? And we're seeing this across the spectrum. So, touched on earlier, Trey touched on just the US, but, you look back to COVID early 2020, global governments dumped $4 trillion in the first 3 months alone into the system. And it goes into largely, it was touched on, into the shadow banking system, right? This global yield carry trade. We have negative interest rates. I'm being paid to take money from the government, swap what used to be junk debt, which we're now calling, AA or AAA credit rated paper, take their negative interest rates and rebuild my tier one capital ratios globally by investing in anything that pays me above this negative yield, 1.7% to 3% dividend yield, or what's now considered high yield, and earn a spread and fictitiously rebuild this tier one capital ratio. So as long as governments keep endlessly printing to fund deficits, to slowly, grow their way out of the debt conundrum that they're in, through financial repression, this market valuation is going to continue to move along. And, I'm a big believer, commodities, hard assets, precious metals, these things at least continue to track in nominal terms and act as that store of value during these types of scenarios. So, I'm still highly positive on precious metals and commodities in general.
Right.
I would say, though, from my perspective and being a student of the markets and monitoring the markets and, living through the dot-com bubble as well, I'm not so keen on the energy sector yet, on the oil and gas sector. Precious metals, gold in particular, people forget, is early cyclical recovery. And my gut feeling is we're 2 years into that. And we're starting to see an uptick in silver a little bit, tracking gold as poor man's gold now. Industrial metals, mining, copper, zinc, nickel, everything else tends to be mid-cycle. So that's just starting to move. And we've seen China come back after the New Year holiday here. And people are, positive about copper and the industrial suite of metals and energy, which is, 57 to 65, 68% of the input of everything, chemicals, reagents, explosives, diesel, everything. That's late cycling. So I still think we're 2 or 3 years away from a real nice uptick in the broader oil and gas sector. And as you touched on, Barry, I think, transportation, business travel, air travel, driving, that's going to be a slow recovery because I don't think this life is going back to normal as quick as people might estimate after COVID. I think it's going to be more of a slow, stretched out 4 or 5 year type of recovery to get back to normal from the business perspective, and business travel and driving, which is a big draw on that energy suite as well. So that's where I'm thinking about the commodity basket right now, where we are in the cycle.
Interesting. So clearly, gentlemen, we've got some real solid themes here, hard assets. The impact of cheap money and stimulus into the market and how that works its way through. So clearly we're not over this, and there's a lot yet ahead of us to actually deal with. But Jamie, since you have the floor to a certain extent, maybe we could switch into the second part of what we were kind of planning on talking about, and maybe you could kind of set that stage for the phenomena that's been going on, which is somewhat of a pandemic-related phenomena with respect to, as you said, GameStop or Reddit or Robinhood, or the volatility that has come in between what's been termed as the small investor battling the professional traders, and the volatility and some of the dramatic moves that have occurred in short periods of time on junior penny stocks. Period, doesn't necessarily impact mining, but what that really, could you just set that for us and put it in some kind of context about what that's all about, and then we'll get to each of you how we actually deal with that. What does it really mean? But please, Jamie.
Sure. Yeah, I think all of us here, students of the market and the way we were trained, and you touched on classical economics, and the first rule of finance and economics you're taught is capital is scarce and it flows to where it can earn the best economic return, right? And what we touched on earlier segues into the broader market in general. Governments are on the gas pedal since the global financial crisis. They're endlessly printing money. We're undergoing financial repression as a result to fund deficits. Capital isn't scarce. In fact, capital not only isn't scarce, money's free. They're paying most institutions to take it. So when money's free and you print endless amounts of money, you really start to scratch your head over what discount rate or what I should be using for assessing risk. So risk is zero. The discount rate is zero. So valuations can be infinitum, right? So we're starting to see, like we witnessed in the dot-com bubble, this time is different, right? Case-Shiller PE multiples no longer relevant. The Wilshire 5000 to GDP level that Warren Buffett talks about, no longer relevant, right? Dot-com bubble was things of price to sales. And it's funny to watch GameStop and Reddit and these chat rooms and these types of things and live through the dot-com bubble where, Stockhouse and these types of chat rooms were just starting to get off the ground. And I started in the financial industry in late 1998, and about a year or so into it, we had employees that quit after 2 days because loans were so cheap and they can get a home equity line or some other type of margin loan. And it was so much easier to make money in the stock market. We'd hire people and they'd quit after 2 days to go home and day trade. and they'd sit on Stockhouse and they'd chat about stocks and they'd day trade, back then a lot of .com stories. And, we could all remember, and, Barry, firsthand, few gold companies or anything that converted their shell into a .com trading on crazy valuations, right? And the government stepped in a few examples there, and they looked at the Stockhouse chatter, and they looked at the manipulation, or what they believed was a manipulation of the stock. And when they came across something where, there was obviously some type of groupthink or a pump and dump or some type of manipulation, they eradicated all the trading and all the profits in those stocks and took it back to what they thought was, the uninhibited stock price prior to this manipulation, and wiped out all those trades. So I think it's interesting from GameStop that the market and these types of things, that the market seems to be rhyming here. There's a lot of keys when, what's this individual here? He goes by the name of, here he is, Keith Gill, the Roaring Kitty, who's supposed to present tomorrow, right? Right? The key here is, he's claiming there's no solicitation of anyone to buy and sell the stock. He didn't solicit anyone to trade. So he's claiming, there was no pump and dump scheme here. He didn't belong to any other group or trying to create movements in the stock price. So he didn't work in concert with anybody to manipulate, is what he's saying. He doesn't have any relationship with a hedge fund, so he's not paid by anybody. And there's no material non-public info. So this is the type of thing that the regulators are going to have to step in and investigate. But I hear the frustration as well that we touched on earlier. If they're going to regulate the market, then they better properly regulate the entire market, not just, these Stockhouse chatter and these types of individuals, but also those hedge funds, certain individuals that can no longer run money for others because they used inside information and they paid for inside information, or intelligent networks, as they used to call it, right? So I feel the market is rhyming here. Eventually it will end badly. This time is not different. And similar to 2000 into 2002, unfortunately, a lot of the commodities, precious metals and others, everything will take a short-term sell-off as you need to repay margin loans. But I think that's a blip in the longer-term scenario here of where we are on money supply, bailout programs, COVID bailout, ongoing printing of money, and what that means for the nominal asset prices.
Byron, if you could maybe add to this as well. I know you have some thoughts about, and put it in from your perspective, this phenomena that's gone on. And, I think we have a common view here, but maybe it's worthwhile that you kind of delve into it. How does an investor actually deal with this kind of noise and frenzy? And we have seen it before in different ways, but what would your advice be to the average investor out there who's contending with this noise?
I think first thing you have to do is look yourself in the mirror and decide, who you are and what is your risk profile. Now you can have multiple personalities. If you take your nest egg and you divide it up into thirds, 1/3 will be my super high risk, just put it on the gambling table and let it evaporate. If you can live with that, that's cool. And the other third will be, this is my, really prudently managed money. And the third is sort of, I'm just going to put this away forever, just kind of. If you want to look at the long term, I like to look at the long term and then sort of work my way back. When you look at all of the money creation by the U.S. government and by Western governments in general, they are destroying the currency. Sooner or later, it is going to die. The question is how soon, how late, how long can you wait? In terms of just basic investing things that everybody ought to do. If you don't own some precious metals, physical precious metals, gold, silver, platinum, what have you, if you don't own some, get some. It's like we used to say when I worked in Texas in the oil fields, if you don't have an oil well, get one. But if you don't have some, you don't have gold bullion, and be careful about the numismatics or the the first issue kind of stuff. I mean, you pay huge premiums on that. But own some physical gold. If you should be in the gold space to, the gold silver space, the mining space. Royalty companies are great. Huge upside on those things. The well-run gold miners. Then the more you want to get into it, the more you get into the small ones, the more speculative ones. I'm a geologist. I'm sitting here with my nice tie on and everything. But I am this is my rock hammer. This is my Brunton compass. This is a 1913 Brunton compass, but I have a much more modern one right here. Brunton.
That's a hard asset. That's a hard asset.
A hard asset. I'm a real geologist, right? I go out and kick rocks. When I'm not grounded due to COVID, but I go out and look at gold mines and silver mines and copper mines. There are fabulous things, in that space. In my own newsletter, I've been banging the drum for rare earths, for example, and I've mentioned some names that are, that are just exploding right now in the rare earth space. I don't want to color outside of my lines here. I'm not the guy to talk to about cannabis and biotech or what have you. But for an investor out there who's trying to figure out what to do, figure out who you are first, and what's your own personal risk profile and how much work do you want to put into it. If you're day trading, good for you, keep track of everything and pay all your taxes. But there are times when in the small markets, you'll have up, down, up, down, up, down, up, down. You'll do a lot of that. And then eventually you'll have one of those. It's nice to have those 15 and 20 and 30 baggers. But you've got to really think hard to figure out which one is the 30 bagger before you buy it.
Well, absolutely. And there's no doubt about this, Byron. I'm not a great day trader at all. And so I'm definitely not one of those guys looking to put on a long position in the morning and close it at night. So my personal view has been I've looked right through all this, and it's kind of interesting. Unfortunately, I think some people are paying a price and getting caught up in that activity. And if I hear what you've just said is, a more rational, traditional approach to investing. But Trey, perhaps we've got, I think, about 5 minutes left here. Maybe you could weigh in on this. And you've seen these kinds of phenomena before. I always like the one as well, which Jamie had touched on. We invent new valuation metrics just to explain the craziness that's going on in the marketplace. And one of the things that we say as a mining analyst, if I've got $1 billion market cap and no resource, I really do have a problem, in the sense that I'm ahead of myself. So maybe, Trey, you can kind of weigh in a little bit on this. Or is this all stuff we should just look through? And is the market at a point where it's maybe a little extended because of the cheap money that we're involved in? Maybe you can give us some sense of that.
Well, look, I think we could circle back really all the way back to Byron's intro here, and and talking about things just moving faster for one thing. Everything is speeding up now. The pandemic and the virus have certainly accelerated things, but it's a phenomenon that's been happening anyway. Through social media and everything that's happened in the last 10 years. And I don't know who is it that there's some law that applies to microchips. It's not Murphy's Law, but it's similar to that. Byron, you could probably help me with that one. But look, I think we can hear through all of this. Certainly there's a lot of speculation in the market. There's a lot of liquidity out there that the Fed is doing. There's a lot of printing of money. There's a lot of bad things going on in, what's basically a pretty good world. So I think if you look through it all and say, well, things are going to end badly at one point, but people who are prudent, even those wild speculators, you don't know how many of them are actually converting some of their Bitcoin to real gold as they go along here and taking some profits. But one thing I'll point out is that I think unlike the stock house of the 2000s, you've really got phenomena that's happening here with a whole generation of millennials, 20-year-olds to 30-year-olds, and historically, when you're in your 20s, you're groping for what you're going to do with your life. In your 30s, you're buying a house and raising a family, and you're sometime into your mid 40s or even 50s has always historically been the time when you became an investor. Now, we can blame it on the pandemic, we can blame it on social media or credit. I shouldn't say blame, but credit. But we really have a whole new generation of 20 to 30 million new investors that are hitting the market all at once. And they're hitting it at a very speculative time with the money. I mean, I heard a story the other day where a guy took, through this GameStop thing, he took his $1,200 relief check, turned it into $36,000 in, GameStop and AME and, so, yeah, good for him, right, Byron? But I think that's what we're looking at is what really could change things coming out as things unwind here, if you will. We are going to have a lot more people looking at investments, and hopefully the successful ones and the ones that really stick with it will start to as they lose some money, start to come up with more conservative ideas. And of course, running a gold royalty company and being, heavily invested in gold myself, between the company and physical gold, and I think that for a lot of reasons, we're going to see the precious metals be a choice ultimately for a lot of new investors in the space.
Okay. Maybe Jamie, if you could bring it home for us to a certain extent. Certainly this activity, and I hear what Trey is saying, that this new group of investors who's very short-term, very fast in the market, and we've had this trend from passive management from active management into passive management. Maybe this is just a short-term sudden reverse of that, and way too much active management going on in the market. But maybe you could kind of just close us out on this topic, and your kind of somewhat final thoughts about, how is this ultimately going to play out? Is it just going to come down to simple regulation, or is it just going to be take care of itself with blood in the streets? How does this ultimately play out?
Yeah, first of all, Trey's comments, I wouldn't call these people investors, right? I call these people speculators, right? And like the dot-com bubble, we had a lot of speculation. And once again, it is the 20 to 30 somethings that, they're online, they're on whatever, Robinhood, they're getting live updates on their phone. I know a few people, we're hearing these stories again, if we could travel and you were in an Uber, maybe your Uber driver would ask you about certain stock ideas, stock picks again.
or your barber, your barber, which I haven't been to in a while.
And we'd be in that scenario again, but it is that 20 to 30 somethings again, using margin, right? Or option purchases, right? Leverage. With $5,000, $10,000, $3,000, $1,200, whatever they have. And for every, roaring kitty or this individual that takes $1,200 and converts it into $35,000, there's probably at least 10 liars and 20 people that are losing on the other side, right? But you don't hear about those stories. And we witnessed that firsthand in the dot-com bubble. I find it interesting now, we really didn't touch on Bitcoin that much. I'm not a big believer and proponent of Bitcoin personally myself. I'm reading these stories on Bitcoin and articles coming out, and Jeffrey Gunlatch and others now kind of throwing in the towel and talking about selling a little bit of his gold positions to play Bitcoin. And it's reminiscent and rhyming with me of portfolio managers that, they were supposed to be value managers and they threw in the towel and they were chasing Nortel and Global Crossing and all these other things, right? And they just eventually had to buy it. And I think that's where we are in the stock market and in general and risk taking. And it's always a mix of a bit of regulation to prevent us from our own stupidity, right? And the regulators come in and review things and try to correct the system so everybody has equal access to information at the same time, so they can make informed decisions and correct us from our own stupidity, as I said. And unfortunately, a mix of, pain being felt in the market at some point, right? Where you're going to have more losers, and we have a bit of a reset again. And it's always a blend between those two. And people who getting back to Byron's comments, you have to figure out what type of individual you are and where you sit on that spectrum and what amount of risk you're willing to take, because ultimately fundamentals always win. In the long run, when you're thinking about the long-term scenario and as an investor, fundamentals always win. And that old adage of the market can remain irrational longer than I can remain solvent is true. So you really have to think about what type of investor you are, how much speculation versus investing you're willing to do, whether you can convert some of that speculations and winnings and realize that you were lucky either in a name or in the sector, and convert that into a long-term sustainable plan and investing plan and returns for yourself on a long-term retirement type of basis. And because timing isn't going to work, right? Trying to time the market, it doesn't work. So figure out what type of investor you are, where you are on that spectrum, and have that
absolutely good point
for the eventual whipsaw, because you cannot time that whipsaw.
Jamie, I think that's a great place to end on. Good, solid, fundamental investment investing on solid principles. I think really no argument from this crowd. At some point, as well, showing my age, I hope to get back to the wealthy barber and pick up some tips. I'm not getting them the traditional way. But I think with that, gentlemen, I want to say thank you very much. I think we explored a lot of good concepts here and from some very good different perspectives. And I think with that, John, we'll take it back to you.
All right. Well, everyone can hear me again?
Yes.
Okay. Well, thank you. I wanted to thank all of you. I really enjoyed that. I got a few good laughs. Trey, I'll never forget the "Don't let a good pandemic go to waste" comment. I had a nice laugh out loud moment at that. But thank you all for a very interesting discussion. Barry, great job moderating, by the way, and directing this discussion as well. I thought it was really well done. I just wanted to chime in one thing. You guys talked about using some, new alternative valuation metrics. I did see a pretty funny tweet the other day. I'll give a shout out to Trader Ferg on Twitter, Trader_Ferg. He said, new valuation metrics, price to FOMO ratio, WallStreetBets ratio, and short interest to YOLO calls ratio. Maybe they could put that on the new CFA exam.
Yeah. We also have an interesting thing on the chat line right here. I find entertaining. It's not about believing in Bitcoin. It just is. To your comments on valuations.
On valuation.
It just is.
And I would add that if we're going to wait until we have some blood in the streets sort of event, just try to make sure it's not your blood.
Good point.
Make sure it's not yours.
Okay, well, and for full disclosure, 95% of my net worth is in gold, guns, and Nicaraguan real estate. So it tells you what I work. Nobody should be listening to me.
Don't forget ammo, Trey. It's hard to get these days.
Well, that goes with the guns, yeah. Okay. Actually, probably my ammunition cash has been a better return than Bitcoin this last year.
Yeah, there you go.
9 millimeters, 90 cents a round at this point. That's what I'm saying. So
crazy.
90 cents to shoot around. Holy smokes!
All right. Well, on that note, again, gentlemen,
slugs are $3.
Jeez. Okay. Well, again, this is a lot of fun. Really glad we did this. I think it was a great discussion. So thank you again all for participating and sharing your thoughts. It was great.